What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some analysis for Amazon stock because I recently bought some shares in this company. Even though the stock is up 43% in the last year, and a lot of other similar companies of this size are actually overvalued, this one does not look too bad. As I'm going to show you here in a minute, the PE ratio is not bad based on the earnings that they are projected to do. So let's get started with this company's revenue and net income. As you can see, they have no problem growing their revenue and net income still. Trailing 12 months, they're up to $620 billion of revenue, which is a huge record for them. And then same thing with net income, we're looking at trailing 12 months of nearly $50 billion, which is an insane jump up coming off of $30 billion last year. So great numbers there. Balance sheet is just mediocre. They do have quite a lot more debt and capital leases than they do cash, but that's all right because this company is Amazon and they can get by with that situation. But return on capital employed is 10% last year, but if you look at the trailing 12 months, you can see that the ROI is actually only 4%. But actually, I think that number that's skewed because it's not on a yearly basis. So it probably is closer to 10%. Yeah, I guess when you look at it on a yearly basis, it's not that bad. So those numbers are fine. The important thing though is their projected growth and then their current valuation. The P ratio is really everything with this stock. So EPS going from 2.9, 5.1 to 6.1 expected for next year, which is insane. Revenue growth is still going strong at 10 to 11% revenue growth, so I'm happy there. And so really what I'm looking at here is, all right, so here is the last 5 years for the stock. And as you can see, it spent quite a bit of time at about 75 times. Then it spent some time at around 60. And then this past year, it's been really around 50, right? It's been around 50 to 40. Okay. So right now we're at 44. Well, actually, we'll do some more accurate numbers here. We're looking at a $208 stock, and this is based off of this year's earnings. We are paying 40 times earnings for this year. Now, that's not bad at all. Look at the last couple years, right? 40 times. That's not bad at all. This stock can easily trade at 55 times earnings, okay? Then, not only that, but let's say for next year, we are paying 34 times earnings, which is insane. Okay, 34 times earnings for next year. That means this stock is easily going to go up next year, easily. Now, I am also expecting a correction slash crash in the general stock market. So even if this stock does get hit 15, 20% or something, that's all right. That's why I'm not going to make this a huge position right now. But I mean, 34 times forward earnings is very cheap for where this stock normally trades. Okay, and let's see. I'm actually curious. Let's see what the last 5 years they've averaged 20% revenue growth, and then last 5 years they've averaged 24% net income growth. See, so okay, and they're doing net income growth is fine. That one's spot on. Revenue growth is a little bit slower this year and next year relative to what they normally do in the last 5 years. So maybe that's a factor, but net income is more important, and the net income is looking very strong. So I don't see Amazon stopping to grow, and I don't think their growth is going to slow down anytime soon. I think they have years and years of growth to go. So there's not really an issue there. I think paying 34 times next year's earnings is very cheap, and I think that really this stock at a fair valuation is going to trade at 50 times, if not more. So I mean, I think 50 times is conservative for this stock, which means the stock should be $300 next year. At least $300 next year. That's the way I look at this. So really this is cheap. I honestly could see this keep running up for the next 12 months. But that is my analysis for Amazon. Thank you very much for watching, and I will see you in the next video.